This is a video that discusses a recent simulation posted on Warp Investor on the Warp Investor blog. So let's go through some of the items of the simulation. So on the left here we have a more benign scenario, and on the right we have a less benign scenario. The more benign scenario assumes an earnings growth of 3.2%, and that comes from Yardeni's research. Yardeni's research is very good. So this is Yardeni's research estimate of earnings growth for 2023. And this is the estimate of the analysts and the average of the analysts' perspective on earnings growth in 2023. So that's 1.1%. That is here on the less benign scenario. This is a recent top of the S&P 500. This is the current price, at least at the time of this writing. Um, so this simulation assumes the first rule by Ben Graham's 10 rules. The first, which is that it assumes that a fair PE would be equivalent to an earnings to price yield of twice the AAA bond. That would be treasuries, US treasuries. If the AAA bond yield is, say, 8%, then the required earnings yield is 16%. In reciprocal form, and that's what we use, that's a price earnings ratio of 6.25%. So it's actually a price earnings ratio that is equivalent to an earnings to price yield that would be uh, twice of the AAA bond inverted. So it would be 1 divided by this earnings to price yield of AAA bond. This is how we get to the fair PE levels in this simulation. So this is the yield that we're considering. On the left, it's the 10-year rate, and that's the current 10-year rate at the time of this writing. So 4.941. And this one assumes an uninversion of the yield curve, uh, 10 year to 3 month, and that would essentially be taking the 10-year rate to the 3 month rate, which is 5.47. This tends to precede a recession, this bearish uninversion of the yield curve. So the most recent top of the S&P 500 was achieved more or less here. That's toward the end of 2021. And we are around here, uh, which is October 2023. We had a trough here in September, around the middle of 2022, around September, October. And many believe that this was the recession that we were talking about, because the S&P 500 dropped significantly to 3,000 and some change. But the problem is that unemployment rate has been low throughout, so it's very unlikely that you're going to have a recession with full employment. So it's unlikely that this was the recession. Here we have what I was talking about. So this is the bearish uninversion. This is the 10-year Treasury. minus 2 year. Now, let me go to the one that I usually follow. That's the 10-year minus 3 month. So this is the bearish uninversion that I was talking about. And as you can see, the 10-year is moving toward the 3 month uh, yield, Treasury yield. The inversion of this curve occurred around October 2022, and historical data suggests that a recession happens within 18 months of the inversion. So that would be 1 year plus 6 months. So we are in October 2023. So 6 months from now would be November, December, January, February, March, April. So by April, if you believe in the historical data about the yield curve inversion uh, being followed by a recession within the next 18 months, then the recession should happen around it from now to around April next year. So going to our simulation, so on the left, more benign scenario, taking more benign numbers like the 3.2% in earnings growth in 2023 and the 10-year rate being what it is now, then we have a potential drop from the most recent top of more than 50% and 46% from the current value. Um, on the more negative scenario, we have a drop of more than 58% from the recent top and uh, more than 50% from the current value. These look like very severe drops, which may not materialize, of course, because what is leading to this fair PE and this fair price is actually the high interest rate for the 10-year, which is used for many calculation of many interest rates that influence economic activity. So if we have a recession, very likely the central bank will reduce Fed funds rate and will do things in order to make stimulate economic activity, but that would probably require a significant and sustained increase in unemployment. Now you might ask, well, if this is likely to happen, then many people should be moving to money market funds, so raising cash essentially. And that seems to be what's happening. And this tends to precede recessions, right? So you see what happened here, an increase in cash at hand, dry powder, in money market funds, and this includes retail and institutional. And we're seeing this happening again. Now, the reason why this is much higher than what it was before, like this period here after the 2008 recession, is that we have more money in circulation due to stimulus. And stimulus could lead this number to go up even higher. So we have about 5.9 trillion in cash and money market funds. Now, retail investors, who tend to be a crowd that predicts recessions um, by raising cash, they are doing the same thing. So here you go. Uh, the uh, the uh, the discussion about the numbers that are in the simulation. Thank you for watching. and see you next time in the next blog post and the next video accompanying it.